What's happening, team? I just sold some apron, blue apron. The class starts in a minute. Minute and 10 seconds. Hey, hey, hey. Well, Rowan, not everybody's eating at 5-star restaurants every night like you, pal. That's the truth, James. That's always honestly the word. Like, I'm with you on that. But you want to try to go into the Fed in win-win situations, you know? So if that's the worst case scenario, it is what it is, and don't trade emotionally on it. We're going to get started here in a few seconds. I usually don't. All right. Everybody here? Is everybody ready? Bob's ready. Amber's ready. Chase is ready. 3 people? I'm leaving. Come on, guys. Who's ready? Who's here? All right. That's what I want to see. Let's go. Awesome. Awesome. All right, guys. Shane. Appreciate you all being here for this. So appreciate you guys all being here for this. So today we're basically going to be doing like what is the first class of my training program. My full training program is like 14 or 15 classes or so, and I'm actually still working on adding a couple more in over time. But I want to take us back to the basics here for this first class. I want to get into some fundamentals. You know, my training program, and again, we're going to be doing a lot more of these classes, and you're going to have access to a lot of these classes through the Pro Trader Bootcamp, I believe is what we're calling it, over the course of the next 4 weeks or so, every Wednesday, I think for 2 hours. But today is going to be the starting point, right? So we're going to start more fundamental, and then over the course of these weeks and the course of the access to the class that you have, we're going to get a good bit more advanced relatively quickly. But I can't emphasize how important fundamentals are. Fundamentals are really the key to this business. It all comes down to your fundamental understanding of technical analysis of supply and demand. Just because something is more basic doesn't mean that it's ineffective. If anything, it's the opposite. I'm a big believer in the acronym KISS, keep it simple, stupid. I've seen brainiacs come into this business with multiple PhDs who were trying to make the most complex trading systems in the world and were not successful with it. And I've sat down with some of them and I've been like, look, I understand what you're trying to get across to me here, but this is so complicated. Why don't you start by just learning a breakout trade? And that's actually what we're going to be talking about today. The breakout trade, the breakdown trade is a great trade, and it's fundamental. It is relatively basic, but I'm going to teach you guys what I look for, how I execute it, where I look to put my stop loss, the beginning part of how I start to think about a game plan, but game planning is actually an entire another hour-and-a-half long class, which I'm also going to be doing over the course of the next 4 weeks. This trade, even though it's basic, has been one of the few trades I can think of that's actually been very consistent over the course of my entire trading career. I said this in the last couple of days, I think a couple of times. I've seen a lot of different types of trades kind of come and go over the years, where they're successful for periods of time or successful strategy for a period of time, and then the market changes and all of a sudden it's not successful in the same way as it was. This simple trade, the breakout breakdown trade, if it's done correctly, has been a very consistent trade over the course of my entire trading career. Could that change someday? Yeah, it could, but so far so good. It's been extremely consistent. So I hope that this acts as a great starting point, great fundamental starting point for everybody for an understanding of technical analysis and an understanding of trading. And then again, a specific trade that if you don't already have as part of your tool belt of trades for when you approach the market, you're going to have it going forward. So with that ensemble, that intro, let's get it started. I do always have to start with the disclosure because the compliance team gets very upset. Let me turn off my webcam here for a second so you guys are able to read the entire thing if you choose to. I am an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA/SIPC. All of my trades are placed through T3 Trading Group, through T3 Trading Group's broker-dealer. You should carefully consider whether trading is suitable for you in light of your own financial condition. I think that this meeting is going to be recorded. So, you know, if you want to pause this and go back and read it, by all means, please do so. All right, I'm back. Okay, so what we're about to learn here is going to be, you know, breakouts and breakdowns. In order to understand what a breakdown is or what a breakout is, you have to understand what support and resistance is. Because what a breakout actually is, it is a break of resistance. What a breakdown actually is, it's a break of support. And these are going to be types of momentum, types of with trend trades. But before we can even understand support and resistance, we have to understand technical analysis. Support and resistance are probably two of the most basic concepts in technical analysis, along with the concept of trend. We spent a lot of time on one of the afternoon meetings this week discussing trend, the definition of a trend. An uptrend's a pattern of higher highs and higher lows. A downtrend's a pattern of lower highs and lower lows. When it comes to support and resistance, if I were to ask people here in the room, you know what, let's do it. Guys, who can give me a definition of support and resistance? What is it? What is support and resistance? Let's try to make this a little bit interactive. I want to see a few answers come in here. Give you a moment to type them in. I want to know what the definition of support is or what the definition of resistance is. Preferably from someone who is a guest and not one of my traders who already should know the answer because I've preached it into their head a billion times. Okay, awesome. I'm seeing some good answers come through. Awesome. Awesome. Good answer. Memory of the crowd. I'm seeing a lot of people talking about buyers and sellers, demand and supply. Cool. Good. I'm glad I'm speaking with an educated team here. That's going to make my life a lot easier. So a lot of times if I speak to someone who hasn't been part of a professional team and I ask them for their definition of resistance, they'll say it's the line in the chart where the stock has trouble going above. Or what support is, it's the line in the chart where the stock struggles to go below. And it's not wrong, but it's not the right answer necessarily either. It's not what I'm looking for. Whenever we think about anything related to technical analysis, it's not just this is what the pattern looks like or this is what the line looks like. I really want you guys to always be thinking about supply and demand. Every technical pattern or support and resistance or trend, all of that is always going to be composed of a certain supply and demand dynamic. And if you can start thinking about the market consistently in terms of supply and demand and not just trend lines or chart patterns, and again, I'm not saying that trend lines and chart patterns aren't important, but you need to understand it more deeply than that, right? You need to understand what it actually is from a supply and demand perspective. So support is an area where there tends to be more buyers than sellers. There tends to be more demand than supply. Why? Well, it could be that the market views this price as a discount. Generally, all of the market participants combined view this price as a discount. So therefore, what you tend to see is more buyers coming into the market at that price because they think they're getting a discount, and less people who are willing to sell because they don't want to sell at what they perceive as a cheap price. So that creates more demand than supply. So that creates support. And then you have resistance is going to be the opposite of that. Resistance is an area where there tends to be more sellers than buyers. There tends to be more supply than demand for whatever reason. Maybe people view this as an expensive price. So a lot of sellers are coming in and there's not enough demand out there at that price who are willing to buy at such a high price to be able to satisfy all those sellers. So every time that stock gets up to that resistance area, it gets rejected back down. That is what support and resistance actually is in the marketplace. We want to understand any and everything that we talk about always from supply and demand. Because like I said, I think in yesterday's afternoon meeting, if trading was as easy as chart pattern recognition, everybody would be a billionaire, right? Because you develop your pattern recognition skills when you're 5 years old. You need to understand the supply and demand dynamics and all the layers of probability, which is again is another class, that go into what it is that you're actually looking at. And I see someone in here mentioning that previous support oftentimes turns into future resistance. That's exactly right also. That's a concept that we want to go to. And the reason for that is because price has memory. That's another very important concept. That's going to be your concept of price congestion in the marketplace. Where people have previously traded the market or they have previously traded a security, they tend to be more inclined to trade at that price again. We actually, as traders, a lot of times we want to avoid areas of price congestion because if you can find an area that's very open, like a gap or something like that, the stock tends to be able to trade much more smoothly through it because there's not a whole ton of price memory that's going through there. There's not going to be a previous resistance level right in the middle of a gap that maybe is now acting as support. You don't have that price congestion. Exactly. So that's some really good concepts there. And this is already Rose just talking about this next slide. You know, if you've heard technical analysis doesn't work, it's not that technical analysis doesn't work. It's that your understanding of technical analysis is not deep enough. I really, truly believe that market patterns are overrated. And it doesn't mean that I don't implement them. I look at them every day. I look at them. I trade based off them. I implement them. But anyone who comes in and just thinks like, oh, I just got to memorize these market chart patterns, memorize a bull flag, and I'm going to be a billionaire, you got another thing coming to you. The market is extremely dynamic. And then even after you learn all the different patterns, you got to learn about yourself. You got to learn about your own psychology. You got to learn to be able to control your emotions. And you have to be able to develop rules around your approach. This is another one of my key concepts for success in trading. I've mentioned this several times over the course of just the last couple of days. In order to be a consistently profitable trader, you have to approach the market consistently. Sounds very simple, right? Be honest. Be honest with yourself. Do you really approach the market consistently, day in, day out? Or are you constantly changing things? Let me tell you about the trader who I've never seen become successful in this business, because I've seen this trader, unfortunately, a bunch of times. One day the trader comes in and they say, I'm a day trading scalper. That's my focus. I just want to scalp breakouts. Next day, after he's not successful on day one, he comes in and says, I'm a chart pattern technician. I'm only going to be trading chart patterns. And that day, the trader doesn't make money. Next day, a trader comes in and is like, you know what? Day trading is for the birds. I don't want to compete with these robots. I prefer swing trading. And then over the next day or two, loses money swing trading. And then the next day he comes in and he goes, you know what? I don't need charts at all. I heard about the tape. I could be a tape reader. I'm a tape reader. I'm going to be a successful tape reader. And then he loses money that day. This is a person who maybe learned a tiny little bit about multiple approaches and mastered absolutely nothing and had zero consistency and will never be a successful trader. When in reality, I know someone who is successful on every single approach that I just mentioned. I know people who are successful day traders, swing traders, fundamental traders, technical traders, scalpers, tape readers. But the person that I'm describing who's not consistent, is trying to do all different things all the time, never masters anything and never becomes successful. So again, the key to being a consistently profitable trader is to have a consistent approach to the market. The only way that you can have a consistent approach to the market is to have rules that enable that consistency. And I say this all the time. I honestly don't care what your approach is. Like I do, because I genuinely want to help every single person who is part of the team be as successful as they possibly can. So I do care about that. But I will never come in here and tell Stefan, because he likes to have a fundamental approach to the market, that he will never be successful. I will never come in and tell Rowan, who likes to do day trades a lot, that he is never going to be successful. I've seen all of these people be successful in their approach. You just have to figure out what the approach is that's right for you. And that's actually really difficult as a new trader. Really difficult as a new trader is figuring out, well, what is the best approach for me and my personality? Should I be focused more on swing trading? Should I be focused more on day trading? Is there a specific trade setup that I should be focused on? Where should I start? This class, this is a great place to start. This is a great place to start. Simple breakout trade, breakdown trade will teach you the basics of technical analysis. And then you, on top of that, study yourself. You journal. You journal not just the trade execution, but you journal your emotions. Maybe your personality type just isn't right for short-term scalping. Maybe you need to be focused more on the big picture, more on the daily charts. Maybe you're the opposite. Maybe you keep a position overnight and you can't sleep that night because, oh my God, the market's having so many gaps. Oh my God, what happens if this market gap's down tomorrow? I'm going to be so screwed. You're up all night. That's no good, right? Maybe you're better off focusing on that, just sticking to the day trading, closing out flat every day. Every day is a new day for you, and you figure out the consistency to your approach. Personally, I do a lot of different things. I wasn't that way on day one. I built into the trader that I am today over 12 years trading professionally in T3 Trading Group. I started as a pure day trader, small time frames, 5-minute charts, mainly to the short side. I don't think I kept my first position overnight for 3 years at T3. And then I started keeping positions overnight. And then the market adjusted. And then I liked some new strategies that I was building in. Fast forward 12 years, I day trade, I swing trade, I trade for cash flow. I have a quantitative strategy I developed. I do all of these different things at the same time because I've been able to develop into that. So you have to figure out what's going to be right for you. And again, this class here, where we're getting into some basic stuff, but we're talking about breakout, breakdown. It's a fundamental trade, and I really do think that it's like the best starting point for a new trader who is coming into the business. So before we can talk about a breakout or a breakdown, we have to talk about support and resistance. Because like I said earlier, a breakout is a technical break of resistance, and a breakdown is a technical break of support. Well, you guys just gave me fantastic answers to what resistance actually is. Resistance is an area where supply outweighs demand for a stock. Therefore, it tends to get rejected down. Back when I was going to an office regularly, I used to teach my classes in front of a whiteboard because I felt I could be a little bit more interactive with that. So I'm going to try to utilize, in a pretty basic way here, a digital whiteboard, just to represent a couple of these things and really break down to the most minuscule degree some of these concepts that we're actually going to be talking about. So here is my digital whiteboard. And like I used to say when I was in front of a real whiteboard at the beginning of any class, any new series of classes that I was going to be doing, I'm a terrible artist. Art, not my strong point at all. I'm definitely not future Picasso here. So you guys might have to bear with me just a little bit on my handwriting and my drawing skills, but I am going to do my absolute best here for you guys. All right. So let's focus on resistance here initially, and keep in mind that anything that we talk about resistance, you can just figure out for the exact opposite on support. So let's start by creating a nice resistance level, okay? And again, as we kind of described earlier, weird how that's lighter and then darker. As we kind of described earlier, I don't like the definition that resistance is a ceiling or it's a line that the market can't get above. I want to stick to that supply and demand definition. But oftentimes what that turns into is a straight line, or, and I won't get into this right away, but we can talk about it. A lot of times support and resistance are zones, they're areas. It's the area between $50 and $50.30. But for the moment, let's start by keeping it simple. Let's assume that it's just a straight price, which sometimes it is. It's always significantly more convenient when resistance is a perfect exact price, because it makes it a lot more easy from an execution perspective. So let's start with that assumption, and then we can break it down into zones in a little bit. So let's assume here that this line that I just drew, let's call it $50. Apologies for the chicken scratch, is going to be our resistance level. Okay. So for a stock to actually get up to resistance, what does that mean? What makes stocks move? Well, a stock goes up because at a given price, more people are willing to buy it than sell it. A stock goes down because at a given price, more people are willing to sell it than buy it. So if the stock is going to go up to resistance, then there has to be buyers that are bringing it up there. So the first thing we might have is maybe today our stock opens up at $49.50 just to make up a price, and the buyers come in right away and they start driving it up. And maybe it gets up to $49.90. And in front of $50 here at $50, that's where our previous resistance zone is. Now, how do I know that $50 is a previous resistance zone? I know it from my charting. Specifically, and this is really important, daily charts. Daily charts. I care, and I'm happy I see TH15 asking me a question on Amazon's resistance level. I'm actually happy to bring up specific examples from the market right now or from the market recently that we can take a look at. Just give me a bit on it, because it's hard for me to switch everything kind of back and forth. So anyway, as I was saying, in order for the stock to approach $50, there had to be buyers. So in the beginning of the day, we're focused on the buyers coming in. And how do I know that $50 is important? Daily charts. Daily charts. That's what I wanted to emphasize. You got to be looking at your daily charts when you're doing your pre-market research. The support and resistance that I really care about are going to be on daily and weekly charts. The big time frames are going to be daily charts, weekly charts. I want the big time frame support and resistance. It's not that I don't care about a 5-minute support level or 5-minute resistance level. I do. It's just not what I necessarily always want to execute on. Why do I care about daily charts and weekly charts for their support and resistance levels? Because support and resistance that you see on a daily chart or a weekly chart was formed by an institution. It's institutional support and resistance. A 5-minute chart, guys, I like to consider myself a big trader because my P&L swings back and forth, 5 figures every single day. I'm not. I'm not managing billions of dollars. I'm not a massive. I'm not, Tiger. I'm not Soros. I'm not a massive hedge fund that's managing billions of dollars, right? I've got big P&L swings that can move some money around, and I might be able to actually create support or resistance on a 5-minute chart for a thinner stock. As a matter of fact, I have in the past. There's been times, and I don't necessarily recommend doing this, but there have been times when I've been long a stock and I'm seeing an area that I want to hold as support, and I start putting in these orders, right? And by putting in those orders, I know that the algorithms are going to join those orders. So that inherently makes my orders a little bit stronger than what I'm able even to do on my own, especially if it's a thin stock. So I'm putting in some orders. I get the algorithms that join me. Maybe I get filled. Maybe I don't. Market comes back down to it. I put those orders in. I put some more in. I don't mind taking a little bit of extra stock. The algorithms are joining me. I'm literally creating. I can do this in thinner stocks, creating support on a 5-minute chart. And again, as much as I like to think I'm this, you know, great trader, you don't want to be leaning off of me. I'm not a big enough of a support level that you want to be buying off the support level that I just personally created. You want to be leaning off the support level that the institution created. You're going to see those levels on daily charts and on weekly charts. Thanks, Cody. So historically, I've seen that $50 as resistance. So when I'm doing my pre-market research, I see, oh, look, XYZ stock here has resistance of $50. So what I'm going to do as part of my pre-market research is I'm going to make note of that, and I'm going to put a system alert out in front of the level so that I know that when the stock is approaching $50, I get this, you know, I trade through T3 Trading Group. The software I use is Lightspeed. We have several other options that we utilize, but the one that I use personally is Lightspeed. So you get these big flashing alerts in front of you. So if XYZ stocks was set to open up at 49.50, I put an alert out at 49.80, probably. For $50 stock, probably I would go 20 cents away. So when the stock gets up to 49.80, when the stock is, you know, maybe if we're saying that this high here, if this high is going to be 49.50, stock gets to, you know, 49.80 right here, bam, my alert's going off. I'm getting alerted by the software. Then what do? I type it up and I communicate to the team. I take a look. I want to, you know, am I planning on executing anything here at $50? And do I want to short off resistance? Am I looking to buy this breakout? And then I go, hey team, guess what? $50 is a resistance level. Let's all check it out. And guys, this is why I can't encourage you guys enough. Please communicate in the virtual trading floor. Don't be shy. Don't worry about saying something dumb. We all say things dumb. That's the best opportunity for you to learn. But if you're communicating, you're going to help everybody make money. Because you're going to communicate an idea. Maybe you're like nervous, like, oh my God, I don't know if it's a good idea. I don't want to type it. There's hundreds of people in the VTF. Like, I don't want to say something stupid. If you say something stupid, have thick skin. It's an opportunity for you to learn. The flip side, maybe you say something really good and you just made 10 people on the team a whole bunch of money. That's the type of environment I want to foster. I said this on day one. ProDesk is not about me. I might be the person who started it, who leads it, or whatever. It's about the team that we've developed. It's about the communication that we have in here. So this is the process. Pre-market research. You identified $50 as the level. You put your alert out at 49.80. The alert goes off. You type up the stock in your system. You communicate to the team. Hey guys, check it out. XYZ stock's getting up to $50. Do you think there's anything we can do here? And then we go, oh my God, it's 9:35 in the morning. There's momentum. There's volume confirmation. We got to buy this breakout. Let's go. Or we go, ooh, it's 12:26 in the afternoon on a Fed day, and there's no volume, and everything looks anemic. I think I just want to hold off on this, but appreciate you, bringing that to the team. So anyway, back at it. Stock's getting up to resistance. What is resistance? Resistance is an area where there tends to be more sellers than buyers. There tends to be more supply than demand. A lot of the times at resistance, the real right way to describe it is we have what's called overhead supply. People who have been offered in this price, maybe an institution who's been offered at this price for a while because they think that this price is expensive. I don't know if Stefan's here, but when Oxy was at like 30, he was saying he had a price target of $75. Maybe Stefan has had an offer in front of $75. I think he was saying 75, maybe 70. Maybe he's had an offer in front of $75 every day for months because he's been long and crushing it. And now it gets up there and he's overhead supply. He's just been sitting there. Well, institutions are going to think the same way. My target's at $50. I just got a big offer at 50 or in front of 50. Maybe it's a big offer at 50. Maybe there are other traders like us who see the previous resistance of 50 formed by that institution because it's their price target and they sell in front of 50. If you think 50 is resistance and you want to go short off that resistance because you're expecting institutional supply, you should not be offered at $50. Really important, guys. You should not be offered at $50 if you think $50 is resistance. You need to be offered in front of $50 if you want to short in front of it. You want to be offered at, it depends how much you're willing to pay down, $49.80, $49.85, $49.90, $49.95, something like that. You want to be offered in front of it. Because if you're offered at 50 bucks and you get filled, the stock's already breaking out and you're probably going to lose money. You need to be offered in front of it. And that's actually the first trade. I know we're here to talk about breakouts, but the first trade when you come up to a resistance level that you should ask yourself is, well, should I short off of resistance? And this actually tends to be a good trade in range-bound markets, especially range-bound markets that have lower volatility, which is not the environment that we're in right now. So I'm not really here to teach support and resistance, but it's naturally, part of it, shorting off resistance. I don't think that this has been a fantastic trade for this market environment. In certain spots, certain days with a laser probability, sure, you can do it, but I still really like the breakout trades. So if you're looking to short, you're looking to short somewhere in front of 50 bucks. And then what happens up here? Well, you had the buying that brought it up to 50 or 49.90, we're saying. You have the overhead supply that's here. If the overhead supply is stronger than the demand that drove it up, then the stock will get rejected off resistance. And that's what creates resistance. So next thing you know, you get a pullback off resistance. And if you did take that short, you book profit on the way down. What type of trade is this? This is a counter trend or range-based trade. This is not a with trend trade. This is going to be very important to understand that when we start talking about game planning. What I'm not going to get into for today's class is the specifics of reward maximization. There's a whole other class on that. I'm not going to get into specifics of where you should be having your bids to book profit after you shorted in front of resistance. It's a whole nother class. If you want access to the class, sign up. We'll be doing it. So you cover your short on the way down, you book some profit, and then maybe at a certain point, those buyers come back in and they drive it back up to 50 bucks. And maybe you're like, okay, well, it worked once, so why don't I short it again? It's resistance. Let's do it again. And then maybe that works its way back down. And you're like, okay, look at me. I'm a genius. I'm booking more profit, short of resistance. I'm glad I stuck around at 12 o'clock for Derrick's class so I could learn how this works. And then it kind of comes back up again. And then maybe you re-short it a third time. And then, wow, look at that. It's worked its way down again. And you book a little bit more profit here on the way down. And then all of a sudden you're like, all right, it's coming back up here. I'm going to put my short on a fourth time because I made money 3 times. And then all of a sudden this time it breaks out. Let me take a half step back because I forgot to mention a really important piece of information about a trade. If you guys remember, I think it was in yesterday's afternoon meeting, I gave you 3 definitions. 3 definitions that are the entire basis of my approach to trading. Trade, trend, momentum. I don't even know if I told you guys the definition of trade, even though it's the most fundamental one. We definitely spoke about trend. We definitely spoke about momentum. What is the definition of a trade? My definition of a trade, pencils out, is something that has a technical reason and a technical out. A technical reason on why you're entering and technical out. Out is the term that we use for stop loss. Where are you getting out when you're wrong? So let's review our short seller here in front of resistance. This person is consistently shorting in front of resistance. What's the technical trade definition here? The why is because it's a resistance area. It's the area where there tends to be more supply than demand. So therefore, I want to short because I expect it's going to get rejected down. That's the technical reason. The technical out. I didn't talk about the technical out. That's the really important piece of information I missed for you guys. The technical out, and Trader Mike here just said it great. It's the point of invalidation. It's basically where the market tells you that your idea behind the trade is wrong. And where is that place going to be? Well, it's going to be if I'm shorting off resistance and resistance breaks, my idea was wrong. So my technical stop loss is going to be, in this case, $50. So if I execute here, let's just keep it simple. If I executed 1,000 shares at $49.90, I need to make sure, and this is a short sale, I need to make sure that I have a buy stop to liquidate the position because I'm wrong at $50. And This, by the way, is now we get into trader math. And if anybody here is a brand new entry-level trader, your trader math is so important. Learn it. If you short 1,000 shares at $49.90 and your stop loss is $50, assuming no slippage, assuming no costs, let's keep it simple for right now. How much will you lose on the trade if you're wrong? You will lose $100. You have $100 worth of risk on this trade. And in this case, it worked, and then it failed. So on this last time, the fourth time that you took the short, you are getting stopped out right here at $50, and you lost your risk. Does anyone notice? Little bonus point question here for my fellow nerds, my fellow technical nerds. Anyone notice a chart pattern that led to this breakout? That's also correct. Yeah. Higher lows coming in with equal highs. That's an ascending triangle. This is a technical chart pattern that's called an ascending triangle. An ascending triangle is what type of chart pattern? There's only two types of chart patterns. Continuation or reversal. This is a continuation pattern. Exactly. So if our stock here, and I don't really have too much space, was trending up into this resistance level, and it creates this ascending triangle here, which is a continuation pattern in front of resistance. For people who know my probability class, this is a additional layer of probability for your breakout trade. This is going to be the next trade we talk about. Because when a stock breaks resistance, in addition to getting stopped out of a short, if that's your trade, you also have a breakout. Let's go back to the slides for a second, because I want to make sure I'm not getting too ahead of things. All right, so we just discussed all this specifically with resistance, how you can be short in front of resistance because you expect that supply can push the market down. Every time a resistance level gets tested, there's a higher probability that that level will break. Let's go back to the example here for a second. This is also a really important concept. So not only do we have this ascending triangle, but this is the fourth test of resistance. Think about it conceptually. Think about it from supply and demand, which once again is the key. We know that there is demand, because if there was no demand, it never would have gotten up here. But we know that it gets rejected because there's more supply than demand. Specifically, we discussed this concept of overhead supply. Stefan is long Oxy from $30. He's offered at $70 for weeks because that's his price target. He is overhead supply. Well, the first time this approaches $50, some of those sellers get to sell. So they're gone. So if we've got, 500 people in the virtual trading floor today, I don't know how many it is, but if we got 500 people in the virtual trading floor today and it gets up to this resistance, maybe 200 of us just got to sell. Well, guess what? There's still 300. So when the buyers drive it back up, maybe another 100 shares, I think it's getting recorded. One of the trader counselors can answer that. It gets back up here. Maybe another 100 of us get to sell. That's 300 of us gone. It gets up here this next time. Another 100 of us get to sell. That's 400 gone. Gets up there this last time. There's only 100 people left. And they get taken out on the way up. There's more buyers than that 100. And that's what actually leads to the breakout. That's why every single time a resistance level gets tested or a support level gets tested, there is a higher probability that a breakout itself will actually occur. Cool. Back to the slides. This is why we got them. Here's just an example, with Google. This is like a double top where there's resistance and the resistance holds, and you can look to short in front of resistance. Support is going to be the complete opposite. Take everything that we just discussed about resistance and apply it as support. I'm not going to redraw the entire example, but you've got, if $50 is resistance where, certain sellers think it's expensive, so they're holding, they're selling up there. Maybe those same sellers think $25 is cheap. So every time it comes down to $25, they got their bids down there. They're willing to buy whoever's willing to sell at that price. So you got sellers who do drive it down to that area where there's greater demand than that supply. They create that bounce back up. And maybe it bounces off $25 support and it was a cheap price and it never goes back there again. That happens. Or maybe it's a pause on the way down of a bear market. right? Which we have certainly seen those pauses in this bear market. You come down to the $25 support, you fill the buyers who think it's cheap. The sellers are like, oh yes, I need to sell, I need to sell. A little bit of a bounce, comes down, test the second time, test the third time, test the fourth time. By that fourth time, if not earlier, the buyers are gone, the support breaks, the sellers continue to dump, the small time frame sellers then have to sell their position, and then you get selling that comes into the downside, which then becomes a breakdown, right? So support is going to be, the complete opposite here. Support is going to be an area where there tends to be more buyers and sellers. There tends to be greater demand than supply for whatever reason. And then this also goes back to what we were talking about, right? Every time a level gets tested, there is a higher probability of a break. So to go back to, just to emphasize that point one more time, I don't do, because of the market environment, as much shorting of support, shorting off resistance or buying off support as I used to. But think about, I want you guys to, let's start to plant the seed a little bit on probability. And again, there's a whole class on probability that we're going to be doing, where I get into depth on this. But what do we know? Every single time a resistance level gets tested, there's a higher probability of a breakout. So let me ask you, do you want to take the same amount of risk every single time this resistance got tested if you have a lower probability of success each time? Honestly, maybe. It depends on where you are in your trading career. But as a more experienced trader who wants to trade with risk skew, we talked about risk skew yesterday. I know Amber loves risk skew. We talked about it yesterday. I really think that risk skew is like the key, one of the keys to making big money in the marketplace. Risk skew says take less risk with a lower probability and or worse risk reward. So if I've got a lower probability of my short working each time, then I should be considering taking less dollar risk on each trade. Maybe the first time I risked $500, the second time I risked $350, the third time I risked $200. Last time I'm only risking $100. Even though at the end of the day here, if this is a day, is this a failed trade or a successful trade? It's a failed trade. Resistance breaks. If this was a successful trade, we're not even getting into what it would look like if it was a successful trade. If this was a successful trade, one of these times resistance holds and then the stock goes all the way down and you get absolutely paid. This is a failed trade. Eventually it breaks. But with good game planning, and again, we're going to be doing a whole class on game planning. With good game planning, you can be profitable in failed trades. And this is what I say all the time. Knowing your technical analysis is just one very small piece of successful trading. Like seriously, very small piece of successful trading. Trading is about money management, risk management, game planning. Game planning. It's a huge portion of it. I want to game plan my trades in such a way that on many failed trades, maybe even on most of my failed trades, I walk away losing nothing or even making money. And then think about this. Maybe you take 10 trades and only one of them actually works perfectly. Maybe it's trade 10 out of 10 and it works perfectly. The first 9 trades you took failed. But on 6 of those 9, you were either ending the trade at 0 or green P&L. And maybe the other 3, they were just straight failures. Think about how bad of a day that is. First 9 trades fail. Trade 10 finally works. I'm probably looking at a very profitable day. Because I had 3 trades where I lost my risk. I had 6 trades where I'm 0 to being profitable by a little bit. And I had 1 trade where I made 5-10 times my risk, maybe even more. It's all, if you get, that's where the game planning comes in. It's where the money management comes in. It's where the risk management comes in. That's all you need to be able to do. Anyway, I'm getting off topic. I'm getting into other classes. Don't let me do that, because I will literally sit here all day getting through this class. And we do have a Fed meeting at some point today. Risk management is paramount, right? All right, I'm just going to talk about the concept of size super briefly here. Size is a term that we use for a very large bidder offer in the order book, in your tape. And it can have an effect on the market. I don't really like trade off of size anymore. That used to be a thing that we would actually do 10 years ago, and it was successful 10 years ago, but the market has changed. Most of the time, the big buyers and sellers, they don't show their full order anymore. They're just too smart. But you will sometimes see that at whole numbers or at support and resistance levels, there is significantly more liquidity. So just real quick, the concept of size is basically going to be a bidder offer that's large relative to the volume that the stock trades in any given day. So maybe at 50 bucks, I see this on the New York Stock Exchange. See this on the New York Stock Exchange. What does that mean to me? That is a 100,000 share sell offer because it's divisible by 100. This is a 100,000 share, 100,000, excuse me, I'm getting tongue-tied. Is a 100,000 share sell offer significant? Maybe. Maybe. It depends. How much volume does the stock do in a typical day? Maybe my stock trades 1 million shares in a typical day. All day, an entire typical day, my stock will do 1 million shares. Well, guess what? 100,000 share offer is significant. That's 10% of the volume that the stock does in a typical day offered at one price. Maybe the stock trades 100 million shares on an average day, in which case 100,000 share offer is meaningless. It's nothing. It's just a blip in the radar, right? So that's the concept of size. But if it is true size, if it's the case where it's an offer that's 10% of the average volume that the stock trades, that's significant for a couple of reasons. One is because it adds to resistance. It adds to supply. You can literally see it. And not only can you see it, everybody can see it. So other people are going to be selling in front of it. Other people are going to be looking to lean off of that 100,000 shares. And trust me, they're doing it. Human beings are doing it. Robots are doing it. Heck, robots, if you put 1,000 shares into a thin stock, the robots are leaning off of your liquidity. Okay? So they're shorting in front of this 100,000 share offer. This is all creating even more supply at that area. And it also is going to be very significant for if a breakout actually occurs, because it's showing that there's so much demand for the stock that it was actually able to break through a 100,000 share sell offer that was offered at 50 bucks, which is 10% of the average volume of the stock. All right, so that's the concept of size. Honestly, for me at this point in my trading career, the most important thing about understanding size or anything like that is understanding that it's liquidity. And I can utilize that liquidity to safely enter and exit positions. I could, if this is a 100,000 share sell offer, I could short 10,000 shares in front of it. I don't have to, so it limits slippage, right? What is slippage? Does everyone know what slippage is? Slippage is if you have a buy stop at $50 for 1,000 shares and you get $50.04 as your price, you get 4 cents worth of slippage, right? The reason why you got slippage is because the stock didn't have enough liquidity. If you're trying to get out of a 1,000 share position at 50 bucks and you get $50.04, well, maybe there was only 200 shares offered at $50. If there's only 200 shares offered at $50 and you have a buy stop going off at 50 bucks for 1,000 shares, well, you're not getting $50 at your price. You might get those 200 shares. Maybe there's another 100 shares at 01. Maybe there's another 100 shares at 02. Maybe there's 200 shares at 04. Maybe there's 200 shares at 05. You will take out every single piece of liquidity until your entire order gets filled. That's what slippage is. But if I can find a liquidity point in the market and it's real, which is a whole nother topic of conversation that I don't want to get into because this class is going to go too long, because there's a tremendous amount of fake liquidity in the level 2 and in the depth and in the book. If your level 2 liquidity that you're seeing is actually real, I can utilize that to say, you know what, I could take a 10,000 share position here and I don't got to worry about being able to liquidate the position because I could short 10,000 shares. I got a 100,000 share seller there that I can buy right into. All right, so that's how we want to think about size and liquidity. Yes, the lesson is recorded. Back to the slides here. All right, so that is size. All right, now finally here, been going for 50 minutes. We're only getting into actual meat of the class. Breakouts and breakdowns. Let's do it. A breakout is when a stock breaks through resistance. All right, when a stock clears through a resistance level. The overhead supply that was there gets depleted. The demand was still strong. Breakout occurs. Okay, let's create an example. All right, so what I want to do now is this right here. This right here. This is the breakout that we are discussing. And I'm trading at the same time as I'm doing this class, so that's pretty good, right? All right, this is the breakout that we're discussing. So I want to take this spot right here, and I want to blow it up for you guys. So let's start a new whiteboard. Where is it? It's this one. It's that one. All right, let's start a new whiteboard. Am I on black? I'm on black. Bam. Bam. Actually, let me run that back. I'm going to bring it lower. Sorry. All right. We're blowing up our breakout. So this right here, this is the same $50 we were discussing earlier. All right. The candle on which the breakout occurs gets a special name. We call this candle an ignition bar. The candle in which a breakout occurs, we call an ignition bar. An ignition bar is characterized by being the candle where the resistance breaks, and it's also going to be characterized by high relative volume. That's key. And this could be a 5-minute chart, a 15-minute chart, could be a bigger time frame than that. But most of the time when we're executing our breakouts, we're going to be trading them on a 5 or a 15-minute chart, even though it's on the daily chart. And this goes back to one of my key principles to trading success and to my approach that I haven't actually discussed with you guys yet this week. So it gives me an opportunity to chat a little bit about it. One of the big things that I'm trying to do with my trading is I am looking to have intraday risk from a 5-minute chart or a 15-minute chart for daily chart reward. People love to talk about risk-reward ratios. I want to make 3 times my risk, 5 times my risk, 10 times my risk, whatever it is. I actually don't think that way. I don't think about that when I'm entering the position. Oh, I can make 3 times my risk here. I mean, actually, it's not entirely true. I do on certain types of trades, particularly counter trend trades. I need to make sure that my small time frame reward potential is worthwhile to take it. But what I really want to do, and I'm especially doing it with this type of trade, and I'm especially doing it with most of my with trend trades, again, a short off resistance or buying off support is an example of a counter trend or range-based trade. A purchase for a breakout or a short for a breakdown is a with trend or with momentum trade, right? Remember, we're blowing up the example from earlier. We trended up to resistance. The breakout is continuing the trend. It is a with trend trade. As a general rule, your rewardability on a with trend trade is significantly higher than on a counter trend trade or on a range-based trade. Okay? And to get back to what I was talking about, what I love to be able to do is look for small time frame risk for daily chart reward. So we were looking for $50. This is a daily chart resistance level. Maybe the breakout in this daily chart has a measured move to $60. But I am executing this trade with 20 cents worth of risk on a 5-minute chart. And then eventually what we want is we want this breakout to be the catalyst that leads to trend continuation. And maybe my stock closes at $51 today. And then it becomes a swing trade for me because I'm 2% in the money. I'm $1 in the money in a $50 stock. And I'm in a win-win situation. And then I catch the entire move to 60. And now I just entered a trade with 20 cents worth of risk and I made $10 worth of reward. That's the risk reward I want. But again, I'm not thinking about the risk reward ratio. I'm thinking about I executed for 5-minute, 15-minute chart risk because I'm going for daily chart reward. That's reward maximization. That's where the big money comes from. And again, going back to the communication from even earlier today, when we had a couple trades, I kept saying to you guys, hold some, hold some. We had some good trades this morning, right? Hold some just in case. Sell some, book some profit, have your stop loss in, have it so that you're going to make money no matter what, even if the trade fails. But maybe it's even a 50% chance that this market rips higher on the Fed today and you don't get stopped out, and then you swing it, and then next thing you know, you came into that trade for 20 cents worth of risk and you're making $10 worth of reward. You will never make $10 worth of reward. Let me tell you a really simple thing, but it's very obvious. It's very true. It's very important. You will never make $10 worth of reward if every time you're 50 cents in the money, you get out. Am I right? So you have to have a game plan in place for reward maximization, which again is my game planning class. So that's what I'm really looking for here. All right. So the anatomy of a breakout. This candle gets a special name. It's called an ignition bar. Ignition bars are characterized by high relative volume. I don't know if we even want me to try to draw, relative volume here, but you would have, your average kind of volume, candlesticks here. And then when you get to this one, it should be like, and I'm out of space, it should be like significantly higher, like double or more than double, like the average 5-minute candle that you're seeing going off for the day. That's going to be really important. Okay. Now, how do we execute this trade? First of all, let's take a step back. What is the definition of a trade? A trade is something with a technical reason and a technical out, right? That's what we discussed. Well, what's my technical reason? Technical reason is that it is a breakout. A technical reason is the supply and demand dynamics of what a breakout actually is. A breakout is an area where the market was able to break through overhead supply. That tells me that there is very strong demand. So, and this is actually, I always thought that this was such an interesting topic because it's somewhat counterintuitive. You want to be short in front of resistance, but you want to be long above it. So what I'm telling you is that you want to be a seller at a lower price and a buyer at a higher price. But that's what that basic supply and demand theory said, that as prices go higher, I want to be a seller. But I'm telling you the literal opposite here. I'm telling you, you want to be a seller at a cheaper price and a buyer at a higher price. Why? It comes down to this concept of supply and demand. Let me ask you guys all a question here. If you wanted to sell XYZ stock here, let's say you're long from $25 and you decide $50 is your target and you just made 100%. And you're saying to yourself, all right, this is where I think the stock is expensive. I want to be a seller. Wear your investor hat even for a second, not your trader hat, but a little bit of your trader hat, just from an execution perspective. If you're long from $25 and you decide you want to sell your stock here because this is where it's expensive, are you going to sell, and you know $50 is resistance, you can see that historically. Are you going to put your offer to sell at $49.90 or $50.10? What do you guys think? $49.90? You selling at $49.90 or $50.10 if you're long from $25, and I'm telling you, you have to sell here. Let's see, 2 answers, 3 answers. There's always a mix of answers on this, so it's fine. Seen a lot of 49.10s, a couple 50.10s. Sorry, 49.90s, a couple 50.10s. Some more people here are saying 49.90. 49.90 is the answer, and I'll tell you why. It's because of the ease of the fill. If you're long from $25 and you're kind of an investor, I know some of you might be thinking, well, $50.10, I make more money, right? And that is true. But does it really make a difference when you're 100% in the money if you sell at $49.10 or $50.10? $49.90 or $50.10 on your bottom line? No, it doesn't. What matters, I love it, Tommy. What matters is that you're able to sell. So $50 has been this clear resistance where the stock has never been able to get above, and you want to sell and you're long from 25, you're not going to offer at $50.10 because you want to be able to sell the stock. And if you're offered above the level that it never breaks, you're worried you're not going to be able to get the sale. So you're going to sell at $49.90, and so is everyone else. And this has a really important implication on supply and demand. It means that the supply of this resistance is primarily going to be at $50 or below. All the sellers are going to be down here. All the supply is down here. So if the stock is ever able to break through 50 bucks, then I know that there's demand because the demand was able to clear all of this selling. But on top of there being demand, there's going to tend to actually be a lack of supply up here. Because anyone that wanted to sell did it already below the price because they wanted to get the fill. And what that can create is like a vacuum where everyone's rushing to buy and there's not many sellers. And then add on top of that, like the day traders, the small time frame traders, the people who had their stop loss at $50 or God forbid $50.01 on their short trade, or us breakout buyers who are all coming in and looking to buy the stock at 50 or above $50. All that new demand, all that new buying that's actually coming in. So we have a rush here. And that's why a lot of the times on breakouts, you see the huge volume and you will sometimes see a very hard, fast, huge pop. The stock gets extended because of the momentum that's actually coming in. So if I'm looking to buy a breakout, I want to make sure that I get liquidity. I don't want to get slippage. So most of the time, there's actually an exception to this. Most of the time, the price that I want to buy for my breakout is actually going to be $50 even, because that's where the liquidity is going to be. And I want to participate in the breaking of that liquidity. Maybe that 100,000 share offer is there, and I'm taking out 5,000 shares of it, and Trader Mike's taking out 1,000 shares, and Tommy's taking out 1,000 shares, and Lulu's taking out 1,000 shares, and LZ's taking out 1,000 shares, and Mike Mesh is taking out 1,000 shares, and Sebastian's taking out 1,000 shares, Val's taking out 1,000 shares, Teacher Teen's taking out 1,000 shares. We want to participate in the breaking of the level. We also want to limit our slippage. So I'm going to look to buy $50. And the way that I'm going to look to do it is going to be with a buy stop. It's going to be a take liquidity order. By the way, most of the time when I trade, I actually provide liquidity. I provide liquidity on like 80-85% of my transactions. And that's because of the maker-taker system, because I'm trading through T3 Trading Group. I have direct market access. The way direct market access works, the way the maker-taker system works, what's up, Brant? The way the maker-taker system works is if I bid into the market, the exchanges will actually pay me money for providing liquidity. And if I take liquidity from the market, then I have to pay the exchange. So for me, it's not unusual for me to trade, over 1 million shares in a month necessarily. I try to provide as much liquidity as I can to maximize my cost basis on my trading. This is a whole nother class. There's actually a 3-part class I have on routing, which I don't think I'm actually doing that one in the Pro Trader Bootcamp, because I don't know if enough of you guys have direct market access to make it worthwhile for you. But for everyone on the professional team, they have that direct market access. Great question, Pete. We can get to that in a bit. So even though I typically try to provide liquidity, on momentum trades, you're going to tend to need to be a liquidity taker. Because if the stock is breaking out through $50, it goes to, starts to get above 50, and I put a bid in then at 50, I don't want that. If that bid gets filled, it means that the trade is failing. The very best trades in the market, the very best breakouts in the market give you one opportunity, one moment to get stock at that price, and then they never see the price again. You got it or you don't. So the way you make sure that you got it is by having a buy stop at $50 for your execution. Okay, and then again, the reason for the trade is because it's a breakout, supply and demand implications that we just discussed in a breakout. What's the other part of a trade? The out. What am I going to use as my stop loss? What I'm going to use as my stop loss is 1 penny below the low of the ignition bar. So if the low of my ignition bar, let's just use some simple numbers here. If the low of my ignition bar is 49.81, I'm going to make it even easier than that. If the low of my ignition bar is 49.91, then my stop loss is going to be at 49.90. It's going to be 1 penny below the low of the ignition bar. Why? Why? That's the question you should be asking. Why? Because, we talked about this yesterday when somebody asked me about trailing stops. Everything you do in the market should be based on the market, not based on you. When I was first taught to do a breakout, and I think that I was taught this wrong initially. When I was first taught to do a breakout, I was taught that it was a pure momentum scalp, and that the stop loss I should use is 1 penny below my entry, or my entry price if it's immediately above. I don't like that. I don't like that. It's not really important to the market. There also tends to be, in this huge movement here, there's like a lot of super fast volatility that happens before the actual upside break actually occurs. And if you're just doing that, you just get stopped out of trades that work all the time. It's just not giving it enough space. I hate when people raise their stop to their entry price, because you're trading based on you. Don't trade based on you. The market doesn't care about you. And that's one of my favorite things about the market. Market doesn't care about who I am, who you are. It doesn't care if you're a man or a woman or what your religion is or anything like that. The market is just going to be the market. It doesn't care about you. So you need to care about the market, right? So I always want to use stop losses where the market tells me that this is where my stop loss should be. So why this price? Why 1 penny below the low of the ignition bar? The answer is because of what this type of candle is composed of. It's composed of very high volume. Very high volume. So if my trade fails, for whatever reason, maybe I took my breakout and it's on a Fed day, and then the Fed comes out and they say something the market doesn't like, and the stock goes down and my trade fails. Why am I using this as my stop loss right here? What do I know about this candle? I know that a lot of people just bought it. How do I know a lot of people just bought it? Because of the volume, and it's a green candle. A lot of people just bought over this period, and every single person who bought in this period, their price is $49.90 or higher. So if it gets below the low of that period, every single person who just bought in this bar, and it's a lot of them, are now out of the money. And what do people do when they're out of the money? They do one of two things. They either sell because they have risk management, or they pray. And I apologize. I don't care what God you believe in. He doesn't care about what your stop loss is in the market or how much money you're losing in a trade. He's not going to make the position come back for you. All right. Those are the two things that people do. We need to get out of the way. All right. We don't want to. So when this low breaks and all these people are out of the money, this can lead to a feedback cycle of selling in the marketplace. And you just want to get the heck away from it. Okay. So that is how to trade a breakout. I'm not going to talk about the reward aspect of it today. That's in the game planning class. And as a matter of fact, when I do the game planning class, I will go back to this exact same example, and then I will talk about how you maximize your reward when the trade works. It's more important to know what to do when the trade doesn't work. All right. From Pete here, what happens when there is a false breakout? You get stopped out and lose money. False breakouts happen. You can keep it simple, stupid. You don't want to overthink it. Now, you want to think about your probability of success. Like I said this a little earlier when I was talking about the example before. You want to think about your probability of success before you take any breakout, right? When that alert went off at 49.80 on the way up, on the previous example here, we said that the alert went off right here at 49.80. This is where you're asking yourself, what am I doing? Your choices are short off resistance, buy the breakout, both, or neither. Doing nothing. All right? So that's what you're thinking about earlier. And what are you making that decision based off of? The risk, reward, and probability of success. Your alert might go off and you go, wow, I really want this breakout, but that ignition bar low is 70 cents down. It doesn't make sense for $50 stock. Risk reward doesn't make sense for me. I can't take it. Or you might say to yourself, oh, wow, my alert just went off, but it's, 109 on a Fed day, and it's not a good time for me to put new positions on, and I'm not taking this trade. I'm not taking that breakout. Or you might say to yourself, wow, this is happening at 9:34 in the morning. The risk is appropriate. The volume is confirming it, and I want in. Like anything else, the more layers of probability, the lower the probability of it being a failed trade. A false breakout is just another term for a failed trade. A false breakout is a failed breakout, right? So that we can't define. And again, I don't want to get into too much of a tangent here, but I said this in yesterday's afternoon meeting. Your job as a trader is not to make money. That's the result of your job. Your job as a trader is to do the right things consistently over time that can make consistent money. So when this thing is approaching $50 here, and you're deciding whether or not you're taking that breakout, you're assessing your layers of probability. You're assessing if the risk reward makes sense. You're deciding if you're going to take it, and if you are going to take it, how much size you're going to take, how much you want to actually risk on the specific trade. And then what you're trying to do is establish the best probability. And if it's a good trade and the trade fails, well, then you get stopped out and you lose your risk, or maybe you covered your risk and then you get stopped out and you lose nothing, right? That's a better goal. So I hope that helps with your question. Pete, sorry, I'm scrolling up because I saw it. How do you apply this strategy with options? I don't know. I don't trade options. I'm not gonna lie to you. It makes zero sense for me as a professional trader to trade options directionally. Why wouldn't you just trade the equity? Is the better question. So the number one reason, and I don't want to get into this too much either, but the number one reason why people trade options is because they're in a retail account, and in a retail account you can get more bang for your buck because it's a natural levered product to trade options. So for me, that's a moot point because I have access to the firm's capital. Every trader who's a professional trader at T3 Trading Group has access to so much capital that they don't need to trade options. So why would I want to trade a less liquid product that's subject to time decay just for capital access when I don't need capital access? So option trading makes more sense if you want to take a shot on something, or if you're spread trading, or you're selling covered calls or something like that. And if you're interested in becoming a professional trader, we can vet you as a candidate if you want to email info@t3trading.com, info@t3trading.com. From Kevin G here, do you ever reverse the position? I always get this question. Do you ever reverse the position at the stop loss? My answer to that is no. Could you try to do that? Yes, but keep it simple, stupid. I don't like trading my failed trades. And then it's very easy. This could become a feedback cycle of selling here, but it also could just turn into nothingness. You don't want to be the trader who just bought here at 50, gets stopped out, and then flips short, and then is getting stopped back out at 50 or at highs or whatever, and then saying, oh, I knew it was a breakout, I should have used the 15-minute ignition bar, and now you're flipping back long, and then that trade fails, and the stock's just going back and forth, back and forth, back and forth, and you are just churning yourself to death. You bought the breakout, you got stopped out, you flip short, you get stopped out, you went back long, you get stopped out, your day's over. So keep it simple, stupid. I'm just taking the trade here, I get stopped out, I'm moving on. But it's a great question. How do you determine your target, and will you hold and make it a swing trade for a few days if the target is greater than the ATR? I don't look at ATR. I think that ATR is a reward limiting factor to pay attention to. The definition of ATR is average true range. It usually goes back about 3 months. It's the average in which a stock trades over the course of that period of time. For me, what I prefer to do is I want to trade the day where it's trading outside the average. So if the ATR is $1, that might mean that in some days it trades 30 cents and some days it trades $2. I want to be trading it the day when it's moving $2 to $3, even though the ATR is $1. Some people look at the ATR and they go, oh, I'm $1 on the money. I better liquidate my position because that's the ATR. And the next thing you know, it goes $2 more because you were trading it on a day when there was news or a technical breakout or volume confirmation. That's what I want. So that's not how I determine my swings. Again, this is another class or an afternoon meeting that we can get into this. But I do always want to have a profit cushion on my swings. I have something that's called a 1% rule or a 1% guideline that I utilize for that, which I can get into on another time because it's away from this class. Jed Clapp, that's why we're here, man. We're here to make money. But if I find from personal experience that if you think only about how much money you're going to make on the trades that you take, that it'll cause you to make less money. Focus on the process. You're here to be a professional trader with a process. Making money is the result. It's the result of the process. Yeah, I don't know what you guys said email Derrick about, but go ahead and feel free to email me. If support and resistance is created by institutions, does it take institutions to break support and resistance or just big volume? It's a great question. Both. Either. Both or either would really be the answer to that. You have to find, Sebastian's saying you've defined risk when you trade options. Guess what? You've defined risk when you trade stocks if you have a stop loss in. Unless you have a swing trade on and that has news and it gaps past your stop. But again, we have rules in place to mitigate that. So you have defined risk with equities as well. Exactly, Trader Mike. That's what we want to think about. From HF, how do you identify it as a significant resistance level? Do you have a historical example? Remind me of your question. I want to go back to that. I want to make sure I get through the presentation, and then I can just pull up a couple charts real quick. If anybody's got examples of support or resistance that they want to look at, as I say that, I change it up. Sometimes they're not a perfect penny. Sometimes they're zones. We said that in the beginning. One that just comes to mind right away because we communicated this short as a team was you see the very clear straight line support at 975 in Tesla that had a breakdown on this day. All you needed, you could still be in Tesla short from 975 at 683.50 if you combined this class with my game planning class. That's it. Because the ignition bar on the breakdown here on Tesla on the 5-minute chart was a little bit expensive. But if you're willing to take that risk on it, it never breached. It worked perfectly. And then if you know my trailing rules for game planning reward maximization, you are still in this short even here at this point. You never got out of it. And you are $300 in the money or whatever. So this is a very clear support that broke. And it's just one that, kind of comes to mind. Other times, just go to WeWork. So WeWork is, full disclosure purposes, I have a position in WeWork. WeWork is an example of one that has been more zony. So it had a resistance zone between like $7 and $7 and like 25, 35 cents for quite some time here. And there was a massive institutional seller that I could see in the tape at $7. And it finally broke out on this day. And now because of the market here, it recently failed. Not only did it fail, it made a straight line back to its support zone. It's got a support zone between like $4.75 and $5, which is now held for 3 days in a row and held back here. It was a little bit looser back here because of fake bad news that came out on the stock. But that's just a couple, real quick examples that just immediately come to my mind. WeWork is stock on trading. Tesla, just a fantastic short that we as a team called out. Anybody here short Tesla from that price? Well, if you're a guest and you're part of the VTF on that day, you're short Tesla possibly. And that's all you need. From Mike Mesh here, if you don't like moving the stop up to the entry point once the trade is performing well, how do you get 6 break-even trades? You got to come to my game planning class for that answer, Mike. It's the 50% sale at 1-to-1 on risk is the very short answer. Selling 50% of your position at 1-to-1 on your risk, and then leaving your stop in place. Kevin G here with a great question, and I'm going to go back to this chart on. Breakouts oftentimes retest support, and what do you do about it? So, maybe I got that initial move higher here, and then it comes back down and it retests the level. So first of all, you're right, this does happen a lot, but I still find that the very best breakouts don't. They don't come back and retest. They don't give you a second chance to be able to get stock. What do I do? How do I respond to this? It honestly depends on what my game plan was and what the situation is. And it depends if it's the same day or if it's a different day. I may do nothing. What I don't want to do, maybe the ignition bar stop is whoops. Maybe the ignition bar stop, and my chart's getting messy here, but maybe the ignition bar stop is like right here, right? This is the ignition bar low. What I don't want to do is turn a winner into a loser. I don't want to buy more stock here and then get stopped out at everything here, including that ad, and just lose money on something that was working enough where I was able to have myself be at 0 on the trade by the time the stop loss is actually coming in. So you got to be very careful with this ad. And there's a difference, and I'm not going to get into this too much, but I have a little mini lesson on it on the Derrick the Trader YouTube, which, guys, by the way, who's not subscribing to the Derrick the Trader YouTube? Come on. That's the one thing I really ask you guys. It costs you nothing. I get a couple cool mini lessons in there. I'm really working hard. It's new. I'm working hard to build it up. Type in Derrick the Trader on YouTube. Press the subscribe button. I want to see that break 1,000. We're almost there, and I'm tremendously appreciative for anybody who does it. And I got a little lesson in there on the difference between an ad and an ad back. So if I'm doing something here, it depends. Am I adding? Am I adding back? I don't want to turn a winner into a loser. So a lot of that's going to be kind of game planning dependent. So maybe I'm doing nothing. Maybe I'm adding back some stock. Maybe I'm taking a new trade there. It really depends. Ideally, honestly, if I executed this initial breakout really well, I don't want it to happen. I want it to just momentum and it's gone. My email is doldensmith@t3trading.com. From HF here. So when it first hits support, you can expect a bounce, and after failing multiple times, you can plan for a breakthrough. So let me repeat that. When it first hits support, you can expect a bounce, and after failing multiple times, you can expect a breakthrough. Yeah, the more times the support level gets tested, the higher the probability of a breakout. The first time it gets there, it has a higher probability of a bounce. It could just smash through it the first time, but in terms of probability, the first time is your highest probability of a bounce, then you have a lower probability of a bounce, lesser and lesser each time it gets tested, and a higher probability, therefore, of an actual breakout or breakdown. Thanks, Trader Mike. Appreciate it, guys. Appreciate it. Thanks, Sergio. Thanks, Ari Baba, Sebastian. Appreciate all you guys. All right, let's. We got through that series of questions. Let's hop on back to the presentation here and let's finish up because we're an hour and a half in and we got the Fed coming up soon. Where is the presentation? Okay, so we just went through what a breakout actually is, how to trade it, what an ignition bar is. This is actually, I don't love this example because it's over the course of 2 bars here. This is actually more of a breakaway gap, which is on my gap class that I'm going to be doing, than an actual breakout because it's off of a daily chart. So this is actually a perfect example of a breakaway gap. A breakaway gap is a breakout via a gap. and the execution is going to be a little bit different than what we just discussed. Breakdown is going to be the exact opposite. So your ignition candle is a selling candle. You're going short. You have a buy stop to get out at the high of the ignition bar. So the complete opposite of what we just did. I'm not going to redraw it on the other side. And here, these are actually breakaway gaps also. Breaks below support, breaks below support. This is daily chart, so there's breakaway gaps to the downside. Again, slight adjustment on how you would trade a breakaway gap versus a breakout, but I'm going to talk about that in my gap class where I talk about breakaway gaps. Breakaway gap is one of my favorite trades. As long as sometimes the risk is too much, but as long as the risk is appropriate, a breakaway gap is one of my favorite trades. So again, execution here. What type of trade is a breakout? A breakout is an example of a with trend or with momentum trade. With that type of trade, you typically have to take liquidity to enter. So what I do all the time is my alert goes off at 49.80 for the resistance level. I decide I want to buy that breakout. I put a buy stop at $50 and wait and watch for the breakout to occur. I might have to adjust that buy stop. I might even have to add a second buy stop based on the risk. If the risk is looking like it's more than I originally thought it was going to be when I put the stop out, I might have to adjust the buy stop to change the size and put the order back in, or adjust it to increase the size and put the order back in. But generally, I'm going to be using a buy stop for the entry of a breakout, a sell stop for the entry of a breakdown, and then I'm going to have as my out, right? That's the term that we talked about for stop loss. I'm long the breakout. I have a sell stop in to liquidate the position at the low of the ignition bar. I could choose to use a 5-minute ignition bar. I could choose to use a 15-minute ignition bar. Or I could short the breakdown and I'm going to have a buy stop at the high of the ignition bar to liquidate the position in case I'm wrong, to manage risk, the high of the 5-minute ignition bar or the high of the 15-minute ignition bar. And that's it. That's it. We're done with the class. So if anybody has any specific questions on this class, I'm happy to take a few minutes to do it. But let's just definitely keep in mind that we have the Fed at 2 o'clock today, and I'd like to have a few minutes personally before the Fed starts. Would I consider 105 as support on Amazon? So no, because I'm starting with daily charts. It might be on a small time frame support, but what did we say? We care about daily chart support. And we discussed the daily chart support actually in the morning meeting today for Amazon. Amazon has support at this like $1.25 to $2.50 area. This area here is the support zone for Amazon that we want to pay attention to. It has now had 3 tests of that support level. First time was actually technical double bottom that gave perfect upside follow through. Came all the way back down because the market has retested it. Are we going to get a 4th test? Are we going to get a breakdown? Or is support going to continue to hold? I don't know. We'll see. We'll see what happens. We'll see what happens in 34 minutes when the Fed comes out. Yep. Right now it's a potential triple bottom. Off topic, will you touch on any opening gap strategies this week? I will touch on opening gap strategies. Well, so first of all, I already have in the morning and afternoon meetings to a degree. I know that so first of all, every gap that we've had so far this week has been a common gap. Common gaps tend to get filled, but they haven't always. And we discussed how this one wouldn't get filled via this time correction, and we discussed in the afternoon meeting kind of what this meant and how you could have traded that. That was 2 trading sessions ago. We haven't had any examples of breakaway gaps this week. So, just as far as the VTF goes, morning and afternoon meetings, my email is Oldensmith. Actually, I have several emails. I work for T3 Trading Group. I work for T3 Live. I work for T3 Professional. I work for T3 Global. So I've got 4 email addresses. The best one to reach me is d.oldensmith@t3trading.com. t3trading.com. But sorry, Mike, I didn't even fully answer your question. Just as far as the VTF goes, we're going to be going based on real-time situations. So we've discussed some gap trading strategies earlier this week. As if the market presents more, then we'll be talking about more. Otherwise, I'm going to have a whole class on gaps in the Pro Desk Bootcamp. So join in. See news here coming from Pat on Citron. I'm going to want to read that later. No, so my email address is, this is the best one. I also have this one. The Oldensmith at t3trading.com, not t3live.com is probably the best. It's the easiest. It's the one I check constantly. Resistance on Amazon. So cool. Glad you brought this up. So sometimes gap fills act as resistance. So we might have some resistance here at the gap fill at 109.05. Your next kind of more major daily resistance, though, is honestly all the way up here at this like 125 area. You just have this one tail going above it. And this 125 area is the next major resistance area. But you might have some resistance from a gap fill here or some resistance from a gap fill here. From Tommy, I got a bit confused. Do you put your buy stop above the ignition bar after it finished forming or anticipating after it break a key resistance or stop below it? Sure. So if we're talking about the resistance break, the breakout, I'm putting in my buy stop before it gets to the price. If $50 is the price, the breakout, my buy stop is going to be there before it ever gets to $50. My buy stop is going to be there when it's at $49.80 or $49.90. So that the second it touches $50 for the first time, it triggers. What I don't want to do, guys, and I'm glad you brought this up, Tommy, guys and gals, what I don't want to do is see the breakout happen at 50, watch it work for 30 cents, and then go, oh, it worked, I'm going to buy stock. You have a horrible risk reward. You want to anticipate the success of the breakout based on the layers of probability, based on the volume. So you want to participate in the breakout itself. You want to be buying the resistance the second it's touching that resistance. That's how you enter it. And then once you're in the position, then you put your stop, your sell stop in this case, in case you're wrong. That's the execution. All right, guys, looks like I got through the questions. Class went for an hour and a half. So I really hope everyone learned something from it. Again, this class here, a little bit more fundamental, but fundamentals are the key. I don't care if you've been trading for a decade. Yeah, it all comes down to your fundamentals. It all comes down to your rules. It all comes down to your consistency. And this is class 1. This is the most basic introductory class that I do. And then the classes get, more advanced as they kind of move through the program. So I really encourage you all to reach out to your trader counselor, get involved here with ProDesk, get involved with the continuation of these classes. I feel confident that you guys are going to learn a lot over that process, and then we want that learning to turn into money in your pocket. So that's obviously the end goal here. So make sure to reach out to your trader counselor on how you can get involved, how you can get the recording of this lesson if you want to watch it again, and just dissect some of the information that we discussed. The trader counselors here, Amber, Ashley, Caroline, they all rock. So don't be bashful. I'm gonna hop off here. I'm gonna end this, and then I'm gonna give myself the next 20 minutes or so. I'm gonna go offline for the next 20 minutes or so just to catch up on a couple of things. And then I'll be back for the fireworks at 2 o'clock today.